Hello, everybody, and welcome to part 3 of our lecture on Chapter 4. And so far, we've learned about the types of merchandising companies, the operating cycle of a merchandiser, and we're starting to talk about accounting for inventory, and we discussed the journal entry for purchases. Now we're starting to talk about the journal entries for sales, and we learned about the difference between price and cost. So, as you recall, hopefully from part 2, there are two different amounts here: the cost, the amount we bought it for, and the price, the amount we sold it for. So my question for you is, knowing what the terms revenues and expense means, which of these two would be related to revenue and which of these would be related to expense? So hopefully you thought about it, and hopefully you came up with this answer, okay? The revenue of the transaction is the selling price, the amount we sold it for, okay? That's the value we received for providing those goods, for providing this monitor, okay? And the $600 is the expense, okay, which is the cost of the monitor to us, okay? It is essentially like the amount that we used up in order to generate this revenue, okay? So keep those thoughts in mind, cost versus price, as we go through this entry. So because there are these two different amounts, the sales transaction needs to be recorded in two parts. Okay, so first of all, we're going to do the first part that we're going to discuss is going to be the revenue part. Okay, so the revenue part of the transaction looks like this. That is the transaction with the customer, right? So we have Computer City, which is our business, and we have Sawa Travel Agency, which is the customer. So this revenue transaction is a transaction with the customer. We're selling them something, and they're giving us something in exchange. So if we look at those things, we're going to say, okay, well, we provided monitors to Sawa Travel. Okay, and I use that term provided here because that's what we did, right? What the work that we performed was providing a monitor. And it wasn't just the monitor itself, it was the fact that we provided it. Okay? So what we provided, the value that we provided to Sawa Travel was $1,000. Okay, they were willing to pay us $1,000 each for the monitors because we, put it in our store, we made it look nice, we let them test it out, we had a nice display. Now, Sawa Travel Agency couldn't go to the wholesaler to buy it directly. They couldn't go to Acer to buy it directly. They had to buy it from a retailer like us, and so that's what they're really paying us for, is for providing the goods to them. Okay. So we're going to value that at $1,000 because that's what Sawa was willing to pay. So we provided the monitors, and then in exchange, they gave us a promise to pay us in the future. And we know that because it says that payment is due in 30 days. So if we look at this transaction, what's happening is we provided goods. And when you provide goods, that is considered revenue, which is equity, and revenue always makes your equity go up. Okay? In addition, in exchange for providing the goods, our customer gave us a promise that they're going to pay us. And that promise that they're going to pay, meaning we're going to be receiving cash in the future, is a future benefit, and a future benefit, of course, is an asset. So our asset is going up. So now we put together the journal entry, and we're going to go through all of our steps. First step is identify the accounts, which, as we discussed, are going to be accounts receivable, and revenue, but specifically the account name that we're going to be using in this chapter is sales revenue. Okay? Now, in reality, the term sales and the term revenue are completely interchangeable. If you were in the business world and you said the word sales or you said the word revenue, you could use them to mean the exact same thing. For some reason, our textbook chooses to specifically use the term sales only related to sales of product as opposed to sales of service, but in the real world, they're used interchangeably. So just know that they mean the same thing. Okay, but in this chapter, when you're looking for an account to use, you're going to use the term sales revenue. And I think they do that like as opposed to service revenue, or they use different kinds of account names. I just wanted to give you the heads up so that you were on board when you're trying to do your Connect homework. Okay, so it's accounts receivable and sales revenue. And we know, again, our accounts receivable are going up because we're getting a promise that they're going to pay us in the future. And then sales revenue causes equity to go up because we're starting the process of making money. So they're both increasing. Then we need to apply the debit credit rules. So we have an asset increasing. If an asset's increasing, that's a debit. And then sales revenue equity, if our equity is increasing, increases in equity are a credit. Oh man, I just now see this typo in my slide. Sorry, I'm going to fix it right now. Sorry about that, guys. But it's 2000 and 2000. Okay. So we put together a journal entry. The date is September 7th. That's when the sale occurred. And again, we record the revenue when we provide the goods, right? They came to our store and we gave them the goods, not when we were going to receive it in 30 days, not when we were going to receive the cash, but when we provide the goods. So that's why the date is September 7th. And that is, to refresh your memory, the revenue recognition rule. So we have accounts receivable, debit of 2000, and we have sales revenue, credit of 2000, and our debits equal our credits, so our journal entry is good to go. But to refresh your memory on another important principle in accounting is the expense recognition or matching principle. And what that tells us is that we need to match our revenues with the related expenses. Okay, so in order to earn that revenue, we had to use something up, which is expense. And we need to match those two things, revenue with the expense. Well, we've already recorded the revenue. Okay, we recorded that we provided, the monitors at $1,000 each for a total of $2,000. And but we haven't recorded what we used up in that process. Okay. So let's look at that other side of the transaction, the expenses, or not the other side. Let's look at, the other part of this sales transaction. We recorded the revenue. Now we have to record the second part, which is the expense. So, the expense, sorry guys, I see another typo. Oh no, that's not a typo. Sorry guys. Getting confused. Anyway, sorry. So the sale of inventory, the second part of that is the expense. Okay, so on the expense side, what's happening there, it's not really a transaction with an outside party. It's more kind of like internal recognition of what happened, because the external part of the transaction was the sale to the customer. They received something of value and then provided us with a promise to pay in the future. But when we talk about the expense, it's a little different because essentially what we're trying to record here is what we used up in the process of generating that revenue. And what we used up was those monitors that are now gone. Okay? So we have to show that those monitors that we purchased for $600 are gone. So first of all, the monitors in the first place were an asset, And now that asset is gone, okay? Because we are now, they're now with the customer. So that future benefit is gone. So we have to show the asset going down, okay? And the reason the asset is going down is because we used it up in order to generate the revenue. We used it through the sale. Okay, so using up something is what we call expense, and so an expense always decreases equity. It takes away from the money that we made. It decreases equity. So we have an asset decreasing because the monitors are going away, and we have an expense which decreases equity because it's taking, it's what we used up to generate the revenue. But the amount, because we have that cost versus price, what amount do we use for the expense? Well, the expense is going to be the value of that asset, which is what we bought it for, or the cost, right? Remember, we bought these monitors for $600 each. So our asset originally was valued at $600 each. Well, now when that asset goes away, it also has to go away at $600 each. So we're going to use 600, or cost, for the expense part of our sales entry. Okay? And the specific name of that expense, which is the cost of the goods that we used up in the sale, is called cost of goods sold. Okay, and I personally think that that's a pretty good account name. It's very descriptive. Okay, cost, that term cost means what we paid for it, and of the goods that we sold is obviously the goods that we sold, the product that we sold. So the cost of the goods that we sold is what we paid for the goods that we sold. So cost of goods sold. So, and I will shorten it often to COGS, C-O-G-S, and I'm going to do this not only in Accounting 1A, but Accounting 1B. So the sooner you catch on to what COGS is, the better off you're going to be. But that is cost of goods sold. And because we're dealing with cost now, that's why we're using the $600. Okay, so let's take a look at the actual journal entry. And so again, we want to identify the accounts, which we did already. We found that there was the cost of goods sold, which was the expense, what we used up, and the merchandise inventory, showing that our asset of inventory is going away. Those monitors are now no longer there, so we have to show them going down. So expense, again, it decreases equity, because expenses always decrease equity. And then our asset is also a decrease, because that future benefit of the monitors that were on our store shelf is now gone, because those monitors are gone. So that was a decrease. So now when we apply our debit credit rules, we say, okay, well, cost of goods sold was an expense, which is an equity account. Equity is decreasing, so it is a debit. So here we have our cost of goods sold as a debit. And again, the amount we're using is $1,200, which is the $600 each times the 2 monitors that we sold, or $1,200. Okay, and then merchandise inventory, our asset, is a decrease. So our asset decreasing is a credit. So we have it here on the credit side, and it's $1,200. And then lastly, our debits equal our credits. Yes, they do. So we are good to go. And of course, we have to put those on our ledgers. So what you see here, we have in our merchandise inventory, the original $6,000 we bought minus the $1,200 that we sold. So what we have left is $4,800. Now we know that they're $600 each. So that means that we have 8 monitors left.